Before a stock becomes hot and captures headlines, social media attention, and retail investor excitement, a quiet and often overlooked process usually takes place beneath the surface. Because markets rarely move randomly in explosive price action is almost always preceded by subtle signals that informed participants notice long before the crowd arrives. Long before the stock trends on finance forums or appears in daily market news, institutional investors such as mutual funds, hedge funds, and pension managers begin accumulating shares gradually, buying in small portions to avoid driving the price up too quickly, which is why early-stage accumulation often looks boring on the chart, with sideways movement, low volatility, and declining trading volume. Even though something important is developing, as legendary investor Jesse Livermore once said, the big money is not in the buying or selling, but in the waiting. And this waiting phase is exactly where smart money positions itself patiently. During this period, fundamentals usually start improving quietly, such as rising revenues, cost reductions, new product pipelines, or strategic partnerships. But these developments may not yet be fully reflected in earnings reports or analyst coverage, allowing early investors to gain exposure before the broader market takes notice. At the same time, technical indicators often begin to change subtly, with higher lows forming, selling pressure weakening, and volume increasing slightly on up days, signaling that demand is slowly overpowering supply. Insider behavior can also be a critical clue, as executives and directors buying shares with their own money often indicates confidence in the company's future, reinforcing Peter Lynch's belief that insiders might sell their shares for any number of reasons, but they buy them for only one: they think the price will rise. As accumulation continues, sentiment starts to shift. Analysts may initiate coverage or revise earnings forecasts upward, and financial media begins mentioning the stock more frequently, though still without excitement, creating what many traders refer to as the early awareness phase. This is often followed by a catalyst, such as a strong earnings surprise, regulatory approval, product launch, or macroeconomic tailwind, which acts as a spark that ignites broader interest, causing volume to surge and price momentum to accelerate. Once the stock breaks out of its long consolidation range, momentum traders, algorithms, and retail investors pile in, pushing the price higher at a faster pace. And this is when the stock officially becomes hot, dominating watch lists and social feeds. However, by this stage, much of the easy money has already been made by those who recognize the early signs, validating Warren Buffett's reminder that the stock market is a device for transferring money from the impatient to the patient. Understanding what happens before a stock becomes hot is therefore not about predicting the future, but about observing behavior, recognizing accumulation, tracking fundamental improvement, and waiting for confirmation, because the real opportunity often lies not in chasing excitement, but in spotting calm before the storm and positioning early while others are still unaware.